All right. G'day, you all. Welcome back. Episode 28, Arnie? 27? 28?
No, 28, mate.
Yeah, it's second one for the new calendar year. So we did our first one, I think, a couple of weeks ago now. We're back into it with our upcoming macro predictions for this year and what we feel is going to be coming up, what's going to be important, and what we're sort of, with a great listener Q&A as to what we're sort of looking to do from our own investment portfolios for this year, always general in nature. So please seek advice whenever you're looking at financial options for yourself. But without further ado, we'll introduce Arnie and Tabone as a special guest today. Is almost regular part of the pod now, Arnie. And
I feel like Brad should be part of the pod, like regularly.
Yeah.
Like
Brad, part of the pod, boys.
Yeah, we've got enough space there. If you move, Arnie, we've got enough space under Joel and Chris there. What do we got behind you?
See just over here. If you can look on my screen and just where that empty fuel tank,
we could
full
fit,
fuel tank.
We could fit Tabone in maybe in like a font 8 just down below.
Just a little small plus Brad.
Brad.
I'll just take a plus Brad at the bottom.
But no, we'll sort that out and get you on, mate. But yeah, Arnie, tax professional, and welcome back, Braddles. Big month in crypto, so keen to get a little update from you on that as well.
Big few months, the opposite direction, but big few months.
yeah, true.
Absolutely. So we'll start off with Rivkin's rules. We'll fire into that. I've got the official book today, so I'm not Googling it. So let's have a look. Oh, here we go. Renee on politics. Given we've got a federal election coming up and we've got a state election in Victoria coming up, not a bad one. So we got 3 for the price of 1 today. If you're a politician, you must sometimes lie. Just accept it. I can't find one reason why anyone would want to become a politician. Individuals can only have a major impact on society by accident. So,
by accident.
Agree.
You
agree again.
You think individuals can only impact society by accident?
Yeah, I think inadvertently, even when you've got the.
That's so dumb, man. That's so dumb because you literally started a business which positively impacts society. Did you do that by accident?
Yeah, but you've got to remember the luck component in there, right?
Oh yeah, there's luck.
You can aim to have an impact on society.
But is he referring more to politicians?
But maybe he's referring to politicians.
He's probably it's under politics, so he's obviously referring to an individual politician.
Mm.
There's also that luck factor, right? It's always like something out of left field that causes them to be in the moment. So
I think Renee is a bit skeptical there, and I feel like people get into politics with the best of intentions and they want to make an impact. And
yes,
I think he's been a bit of a Debbie Downer there. So I don't know, man. Like
I don't know, politics though, you get into it for the right reasons and end up just getting changed by the system, right? So,
oh yeah. Absolute power corrupts. Absolutely.
Yep. I'm sure there's been a few white lies over the past 24 months, especially with
just a little bit
pieces, and even old mate over in the country of Western Australia recently going back, and they seem to have done well through the pandemic. But is it by accident or is it by good governance or is it they've got a strong, better board? I don't know. So but then changing things and changing tunes. So it's very. Yeah, it's quite an interesting, divisive topic, and we'll leave that for another day because I don't want to get stuck on politics. But keep an eye out for the.
We can spend an hour just there.
Upcoming elections this year, federal and state. So the people can choose with their voting power what they want to do.
Indeed.
Great part of being democracy. You think sometimes.
Especially democracy, not with that much money involved. So it's a good thing.
There's a bunch that's been happening. So where do we want to start? We could start really, in any facet. We could start with sort of broadly chatting crypto, broadly chatting property shares. Where are we thinking, guys?
I reckon let's start off at the very highest level of. I reckon we can start off around kind of what Feds are doing, property.
Yep.
We'll probably start off end of cheap money. I mean, they're all things, and that can lead into kind of, growth tech stocks, impacts in crypto and stuff like that.
So this is how much prep we do, guys. We spitball a few ideas and then we decide where we want to start on the topic. So I think macro inwards. So starting from a macro level of policy where we see the Fed going and where we're seeing the RBA voting going, I should say, in Australia. So 1st of Feb today. So the RBA will be coming out and meeting as to what's going to be happening with their minutes and the economic forecast going forward in Australia. they've been pretty steadfast as to not raising rates until at least 2023, I believe their wording was. It was a bit more strong last year with 2024, but
now 2023.
Yeah.
So
Well,
look at that.
to be fair, Philip Lowe did say he would wait for the indicators to fall in line, and that's when he would do it. So he didn't really give a date, but the commentators were saying 2023, 2024.
Well, also in the commentary of saying 2024, then it was 2023.
Oh, they did say it. They were drawn on it, but he has been pretty firm in saying when the other indicators fall in line, that's when they'll look at it. And obviously, I think maybe they've been spooked a little bit because the consumer price data, the producer price data, the wage data, it came out on the 25th of January this year.
I got
the key stats here. It was consumer price index rose 1.3% on the quarter, so that's huge, like you said, Brad.
Up to 3.5, right? So.
Well, over 12 months, it's 3.5%, and the most significant increases were in new dwelling purchases by owner occupiers, 4.2%, and automotive fuel up 6.6%. In PPI, it rose by 1.3% in the quarter, 3.7% over 12 months, and wages rose 0.6% in the quarter, 2.2% over the year, so lagging. Private sector rose 0.6%, public sector rose 0.5%. So still lagging the PPI and the CPI. So, and there was a bunch of other data, but those are the important ones.
Yeah. And I think, the reason why I'm probably taking a more harsh term on the Reserve Bank and the way I think the data was there. I think they've been, personally speaking, opinion only, I think they've been running, they're in a pretty hard position, right, where obviously property has been making up quite a run, and Australians at the moment, quick facts for people, second most individually people in the world, behind Sweden number one, Australia number two, average of 370,000, and latest bank statistics show 37% of people are having trouble repaying forms of debt at the moment. And so I think the Reserve Bank have to kind of be quite careful and be data-driven, Arnie, and not necessarily predict too much, play just exactly what the data's showing and not go early some of the other reserve banks around the world are.
Philip Lowe's governor of the RBA, for the listeners out there, makes all these big decisions. He's come out before and said he doesn't meddle in certain areas of, like property, for example. That's sort of really up to government and APRA to come in and make adjustments where they see fit. They're really taking a full holistic view of the economy of Australia.
Correct.
So, it'll be interesting to see. They're
looking at jobs, right? Jobs creation and the rest of it. So
there was some data I read the other day, so it's sort of a bit contradictory to what Brad was mentioning then in terms of household savings are quite significant in terms of people paying above and beyond their minimum repayment.
It is true.
Loans. So they've got a lot of money in redraw and offset. So they've sort of not been spending as much during lockdowns. Interest rates are really low. So, savings-wise and position-wise, Australians are, in a strong position financially to counteract any future rate rises, I guess, so to speak, because they've just always kept those extra repayments up.
It's an interesting one. Like the statistics Brad mentioned, like that, I've read something similar, Brad. I can't remember when, maybe a week or so ago. I wonder, are those like average, those prices? Are they all in Australian dollars or?
Yeah, not all Australian. So 370,000 is Australian dollars.
Versus the other countries?
I think there's a two-tier thing happening at the moment, right? Where I think I've read stats anywhere between 30 to 40% of people are living paycheck to paycheck and are struggling to actually pay down their debt at the moment. But I think you've got like a two-tier system. I think, Joel, you're 100% correct. Again, I read stats around this 23% of Australians that have got more than 12 months payment ahead in their redraw for the side, right? So there is a bit of protection there, but I'm not sure. Again, it's just stats, right, and numbers.
It's skewed. It's skewed in Australia, right, Brad? Because the average income in Australia is nowhere near the median income. Yeah, the median's much lower than the average. So it goes to show you on the actual population basis, there's the top end are doing really well, and then there's the bottom end who may be struggling. So it's
So the RBA take into all those different factors when they're weighing things up more broadly, as you mentioned, with CPI, PPI, et cetera. So, we'll see where it comes of today. So the RBA is one side of things. The banks always like to come out and, make their predictions on certain topics, share market growth, property, with property. I know generally speaking, the banks are way off with what they predict. So it'll be interesting to see if their predictions come true or they sort of resemble the same old with they have no idea of what they're predicting when it comes to Australian property, which we've spoken about on the podcast before. Economic prediction, we'll see how they go in terms of when they're factoring or when they're thinking to factor in rate rises. We haven't seen as significant inflation as America's experiencing just yet, but we definitely have seen it in pockets of industry copping some decent inflation. And then, we're going to start to see significant wage growth pressures with this low migration that we've experienced. So that's another cost of inputting goods, that making your coffee or a woman making your coffee. And, if they were on $20 an hour and they've had to go to 30 an hour because, it's an employee world at the moment out there, I reckon.
I've got friends in cafes and cupcakes and all the rest of it. And, they're stating at the moment, just to find a baker at the moment, they're paying, an extra $20 an hour just to have a person there selling. They're paying an extra $13, $14 an hour. Right? Yeah. And if you think about that in the cost of those sort of industries where they're low margin, and that cost gets passed along. It's obviously downward pressure on growth, but also removes disposable income and the rest of it. So I think that's important, Joel, which is to say that pressure. And I think the one thing I've been saying for about 6 to 9 months, and it's again, I get a lot of stuff wrong, i.e. crypto, in the short term, but one thing I've been saying for a while is Australia, living in the US and now being back in Australia and obviously being Australian, Australia was in a pretty unique position, I think, through COVID where, Victoria obviously got hit hard with lockdowns and the rest of it. But even then, construction continued on, a lot of industries continued on, and the rest of Australia was largely untouched, let's just say, domestically. Whereas a lot of other countries have been hit pretty hard by COVID, as in terms of COVID taking the workforce out, COVID impacting logistics, etc. And so I think Australia is more just, and I mean the figures in this latest quarter of 1.3%, it's kind of inadvertently proven, at least for now, and we'll see what the next quarter does. But I think Australia's more in that laggard position where we started having more and more COVID cases towards the back end of last year, and we're now seeing the impact of that on the economy again. Just an opinion, but I think one that will be interesting to see what plays out over the next couple of quarters to see if that continues.
I think it's going to be super interesting, especially from a migration standpoint, to see whether that kind of laggard approach or laggard situation you mentioned that we came into because of, I guess, handling it quite well. Say that with gritted teeth as a Victorian, but generally handling it very well the last couple of years. We've been able to get the vaccinations up and vaccinations out, and we've seen that, country to country across the world, that's really helps with hospitalizations and death rates, etc. So whether that's sort of bought us some time in terms of being able to get to a position now where Morrison came out the other day and said he's looking to start to get tourism and migration back happening again and students back in. So, will that take up some of the slack that, with those input costs that we've been experiencing with staff, staff?
Let's hope.
Yeah.
I think the issue you touched on before, Brad, about how careful the Reserve Bank of Australia is like a global thing. Like, I think you'll see that in all countries, in all governments, and in particular I know in America, we're referencing America, and we care about the American economy because that's where a lot of us invest in equities. I think they are facing the exact same situation, and I find it an interesting commentary from the Fed Chair, Jerome Powell, where they've come out and in the written statements, he's been very hawkish. But when he gets pushed on questions, he doesn't answer them in the same hawkish manner that he has his pre-prepared statements in. So in the pre-prepared statements, they've sort of said, I think they committed to 3 or 4, but then there's other commentators who are saying 7 or 8 and go real hard and make the first interest rate hike a 0.5 basis point. So 50 basis points, 0.5, the first hike off the bat. And I think you hit the nail on the head with the same thing's going to happen over there where people have got a lot of debt. And if they go too hard, too fast, then they might have to wind it back and become a little bit dovish and go, okay, we're not going to do this anymore.
Also, the impact on the equities market over there is huge, right? In terms of the free money flow to them. As soon as interest rates start raising, people start putting their money into bond rates and all the rest of it rise.
Well, that's the thing, right? Because there's so many other moving parts of it. You got the yields on the bonds looking like, I think they inverted recently, a few of them. Like the 20 and 30 years have been inverted for a while, but
the 10-year inverted recently.
Yeah, the 10-year inverted, and 10 and 2 are getting closer. Like sometimes it's waxing and waning, but they're sort of moving closer together. which is obviously we know is a leading indicator of a recession or a crash. And there's never been one time in the history of bond yields inverting when there hasn't been one. Like the last one was in 2019, and then 2020 happened. And, was it connected? Who knows? But it did occur. So I think the point I was making, though, was you've got the bond yields occurring. You've got COVID, which obviously was a massive factor in this. And then you had the supply and demand shock. So you had the positive demand shock into a negative supply shock. And now you've got all these issues with logistics in America, which is impacting so many industries, like a real
globally chip shortage.
Yeah, globally, the chip shortage is a really good example because it affects so many industries that have these silicon-based chips. Like Intel or AMD or whoever makes them, they just can't get enough of them out.
TSMC is a big one, right? So they make 70% of all smart chips for cars and the rest of it. So.
Crypto was a big cars sitting around waiting for these chips. They're just ready to go. It was put a chip in, and then you got the storage containers, shipping containers, you had that supply
going one way.
They're coming here, and then I think I heard the other day they're coming here, and then China aren't buying goods back, etc. So they're only doing a one-way.
Same as America, it's just not going back. And on Arnie's point, Tesla, for instance, have come out this year and said they're not releasing any new models because what's the point in releasing a new model if you can't even build the existing models?
Yeah. So
their guidance changed about cars, and Cybertruck got pushed back. So I was saying that the chip shortage in automotive manufacturers, there's certain models, I know with Daimler, which have started removing their heads-up display so they can still sell the vehicles, but without the extra functionality that those chips provide.
Okay.
Well, it's like what Tesla did last year. I mean, Elon used to say that you need radar and not visual chips, and now he's saying you need visual chips.
So they said they're doing that, and they'll just sort of have that as an add back in feature free for the person that buys it in, say, a year's time. Like they'll come back into Daimler Chrysler into the show, to the service, and they'll put it in for them. Or
maybe I don't think so, mate. I think they're just saying these models don't have it because of lack of availability of the chip. So you can still get a luxurious car with all the other bells and whistles, but it just doesn't have these features at the moment.
Yeah, interesting. Oh, it makes sense if they did it and just said that when the supply comes on, we'll add it back in for you. But
I think the cars have been adjusted in price because of it.
Yeah, okay.
I mean, price has gone up, right, as well. I mean,
other inputs.
But I think what you're saying, Arnie, is I think pertinent in that the Feds have a plethora of different variables and factors occurring in so many different industries, so many different, impacts economically that they've got to take in. And
have you noticed, Brad, any similarities of when you left America and come to Melbourne just recently? Have you noticed any similarities of what you sort of just day-to-day life experience there to here in terms of just economics or, finances?
Yeah, I mean, look, I would say the only real significant thing that I've noticed that is similar at the moment is, America started this whole Great Recession thing, and for probably different reasons in that their minimum wage inadvertently, when COVID came through and they realised they don't even have job security in these industries like hospitality and the rest of it. But also when it's allowed them to kind of step away and try and go into other industries, like, going to Amazon fulfillment, so they're at $15 an hour instead of $7.25. And so I saw this kind of inability to get labor in certain industries in the US way before Australia. But then over the last, say, 3-4 months with friends in the industry and the rest of it, it's seeming like when COVID's actually coming in now, and also the flow on from like JobKeeper finishing and the rest of it, I think it's kind of skewed the labour market quite hard, where we're starting to see that a little bit. But in terms of just general wealth, general investment thesis, and general economics, I'd say that Australians are other than that debt side of things, are in a much better position across the board.
Yeah, cool. No, interesting. And I guess leading on from the RBA to the Fed, we've spoken a bit about what we expect for the Fed rate rises this year, and we've seen the market be pretty choppy the past month or so. I think it's had the worst month it's had since the pandemic kicked in 2020. So it's come off the back of its worst month, and then the last couple of days now we're recording as we sit on the 1st of Feb. It's kicked up, had its best, I think its best 2-day run as well. So. Where are we seeing the Fed moving forward this year? We're sort of thinking 4 or 5 rate rises.
I think three max. I think they'll raise it and they'll be okay.
Yeah.
And then I think they'll sort of, if it starts to put a bit of pain, or there's any other factor that comes out of left field and says it's going to put pressure on them, I think they'll have to either leave it or wind it back. I think that's what's going to happen.
Cool. And I guess from a an overall summary of what we're thinking investment wise. We'll probably cover that off at the end of the pod today with a Q&A question when it comes in. So do we want to touch on maybe the crypto side of things with Brad, and then we'll chip in with our great amount of knowledge in that space, Arnie?
Let's do that. But before we do, I just want to add on one extra point. You know how you said worst since the COVID crash, Jolie?
Yep. This
January for the S&P 500, worst January ever recorded for the S&P 500.
Yeah, really interesting. It's coming off really all-time highs, and we're seeing the impact of obviously the new variant as well as potential rate rises and such a strong run.
A little bit of instability in the global kind of political
landscape as well, right? all feeding into a perfect cocktail and concoction of the fall. So,
and I just want to add one thing in before we go to crypto as well. Obviously, due to business, I meet with some pretty, top tier PE and VC firms around the world, and there's definitely been a change of heart over the last year in terms of, not last year, I'd say last month or two, last year, but especially last month or two, with the Fed, with growth tech stocks taking a bit of a hit across the board, with obviously the COVID tech stocks taking a huge hit, like Netflix down 20 or whatever % in one day, and the rest of it on their earnings, and then obviously crypto linked to that. There's a shift in the private equity markets away from kind of growth at all cost due to cheap liquidity, and they're seeing cheap liquidity really going away over the next 12 months. And even now, it's starting to factor in more variables around efficiency of cash on hand, profitability, these sort of things. So whereas before it was like growth at all expense, doesn't matter, kind of around the profitability margins, the rest of it for a lot of these tech stocks. I think throughout 2020, 2021, we had obviously the Ubers and the, et cetera, et cetera, et cetera. And then it's kind of flowing down now to the broader markets. And even this morning in a conversation with a quite a large Australian PE firm that was put on, which is, those kind of multiples at the moment. Hopefully we'll find our feet in the tech stock market, the Nasdaq and the rest of it over the next kind of 3 to 6 months, and kind of find what does that floor look like. But at the moment, everyone is kind of thinking we are in that volatile stage.
I guess for the listeners out there, in terms of growth stocks and value stocks that are price takers, in terms of they rely on cheap funding to be able to continue to push these growth factors and have these 10 times earning multiples, 20 times earning multiples on really low interest rates. So that gets impacted when interest rates start to creep up. Whereas the price makers, your stocks that will do okay during inflation, your value type stocks, they're the ones that haven't had as much of a fall off, and potentially, a bit more proofed proofed as well. So just thought I'd throw that in there for the listeners out there. So in terms of crypto, so if we want to do a quick maybe 10 minutes on this, and then I'll touch on some property stuff, and then we'll sort of wrap up with a 50-50 and a Q&A as well.
Yeah, well, I think we've just lost Brad quickly. So touching on that part about growth versus value, Jolie, I know one of my favorite quotes ever in investing is from Buffett and Munger, where they talk about how growth is a subset of value. So I think the interesting part about what you were saying is it's only going to hurt those growth companies who are reliant on debt and maybe can't service their debt, and not making money.
Especially in, like, say, non-public markets. Those companies, and I saw it in 2020 where, companies is kind of, for those out there, for private companies in the private equity markets, there's generally a seed round, then a Series A, and then a Series B, and a Series D, and you either get bought out or you keep doing Series and you get to IPO. There was a number of companies that were kind of, ready to do their B round, and that means they're burning, anywhere between, let's just say, $1 and $10 million a month. And their literally business model is built on the premise that they're going to get that next growth, that next round, right? And if your business is built on the premise of cheap money and the ability to get that next round, and you don't get that next round, or you get a down round, which is, your valuation goes down, that whole business model is upset. So I think that's a really good point, Arnie.
Yeah, absolutely. And where's the revenue coming from? And you spoke there and gave a terrific Buffett quote. And I guess we have seen such a strong growth market of stocks the past 5-6 years. It's been a growth stock market, and now we're seeing that push across, and we're seeing that sort of oscillate to.
I talk I talk about this stock too much. It's Tesla. It's because it's like a really awesome it's an awesome barometer, but it's an awesome case study into a growth stock which is coming out of its growth phase. Like they're still growing insanely. Like I think on the last earnings call, which was very like last week, they said they're still going to maintain 50% compound annual growth rate. But the thing about Tesla is, since I think 2018 or 19 is when they started to show that they were going to flip to profitability. And I think that's the key about that quote from Buffett and Munger saying that growth is a subset of value. It's like it's value wherever you can find it. And sometimes you can find value in a growth stock, but you have to see that path to profitability and free cash flow, because ultimately it's how much cash can you extract from the business. So anyway, that's enough about that. I love
your Tesla barometer, mate. It's a good one. It's the control. It's the, comes back to everything.
It's my favorite. It's my favorite stock, but I get a lot of flack for it too. Some people hate Tesla, so
I hate Tesla. At the end of the day, I wish I got on board.
So absolutely, I think a lot of us do. So let's see, from Brad's standpoint, if we can keep a nice high level overview within 10 minutes as to what we've seen in the crypto scene since you last came on, mate. It's taken a bit of a downturn.
Taking a bit of a hit on personal portfolio. Taking a bit of a hit. I actually had some friends reach out to me. One of my other co-founders reached out to me the other day and said, "I've been wondering about you. Is it okay? Are you okay?" And I'm fine, because I made an educated guess, and it was a part of a diversified portfolio. Look, crypto has taken a hit across the board, right? So, starting with your Bitcoins, etc., hit all-time highs of 68,000. Fell into the 40s, sat there for a while. Everyone thought there was a new kind of consolidation point, since kind of the mid-price of all new purchases over the last year has been around about the $40,000 mark. So they thought there was quite a bit of support there. We obviously, with the drops in some of the earnings, and so what we're seeing is a large correlation. Since 85 to 90% of all crypto purchases over the last 12 months, so since or I believe over the last 18 months, since June 2020, has been from institutions. I think, what we're seeing is, with a bit of volatility in the broader equities market, and obviously with rate rises coming in the rest of it, it's been a fair bit of sell down and rebalancing of portfolios, and inadvertently crypto has been, what has sent it up, institutional money, also is a factor in kind of bringing it down, right? So there's a lot of people in the crypto markets that are a bit angry and whatever, but they kind of forget that to get the crypto pull up to a $3 trillion, event, it was at 3 trillion and now it's down to about 1.6. To get it up there, it needed institutional money, right? And so you've got to kind of realize that it is a little bit pegged to that. I think a lot of people thought that it was a, deflationary hedge, something against the proper markets and the rest of it, whereas I think it's just becoming another asset class within a broader kind of, diversified portfolio.
Russia. Have you seen any big corps pull out, change their tune on, where they want to?
So you're actually seeing more bullish. I mean, you've got Google Pay now, you've got Samsung, which just teamed up with Cardano to start testing out some stuff there. You've had some big logistical companies now pulling on board. So I'd say that the integration of cryptocurrencies broadly is actually bullish. So the news right now is the most bullish it's ever been in terms of actual real world application and integration into big companies.
So you're talking less Bitcoin and more other
Bitcoin as well, right? So Bitcoin's actually probably integrating into different companies and products way faster than what I thought Bitcoin would. Yep. But we are seeing other kind of currencies now playing front of center with some big kind of announcements out of Africa and Kenya and that around Cardano, and you've got Samsung Cardano, then you have other banks in Solana. And so these kind of layer one solutions are actually, everything's kind of inadvertently going along its merry way in that world. And there's nothing fundamental in terms of the purpose behind it.
And you're about to sort of lead on to Russia. And I think I read, was it Russia, maybe China, they're starting to peg in regulation and banning of mining. And that's had some negative effects on it.
China's done this over the last 4 or 5 years about 1,000 times, but their big one was last year, right? And that's what hit around your June, July last year, when we saw a massive dump from 64 down into the 20s.
Was there another country that brought something in as well, to banning of it?
Russia and Kazakhstan are the other two. So it's an interesting one. So Russia's come out and inadvertently said, look, so their banking minister has come out and said that they're going to start cracking down not just on mining but also the use of cryptocurrency, like in China.
Yep.
And Kazakhstan is purely from a power usage perspective. It's starting to impact their other industries. So inadvertently, it's funny because you've had Russia come out and say that, but then you've had other parts of Russia over the last couple of days come out and say, actually, no, well, let's not just do a blanket ban, especially with, Russia fighting sanctions on US dollars and the rest of it. We want to be at the forefront of this technology. Let's not just completely ban it. So it'll be interesting kind of what comes out of Russia. Kazakhstan is 100% kind of banning it due to mining. So that's not just generally to usage, it's mining. And China's actually, it's quite funny. China was looking at utilizing the digital RMB to really put it on the world stage at the Winter Olympics. And that's not kind of playing out with the way COVID and some political stuff is going out at the moment. And so there's actually been a bit of a change in tune over the last kind of 6 to 8 weeks in China, where they're trying to find out, okay, well, how do we stay inside the technology sphere of it, but not necessarily the mining side of it? So how do we keep ensuring that we can fit this into the way that we like doing business and control, but at the same time, not completely just forget about this part that could be something in the future. And so I think, a lot of the dump is to do with obviously Russia, and we'll see what happens there because they're actually a big player in the crypto market, especially the mining side of things. You have Kazakhstan, which is another big player, about 5-6% of all mining. But I think, inadvertently, there's two factors why I believe that it has dropped. One, the volatility in the broader markets and the Reserve Bank and et cetera, and the end of cheap money, and that being institutional, number one. And number two, I think there's a lot less disposable income available at the moment. And so reading into some studies there, the Robin Hood traders or the people kind of with their $1,500 checks or their extra money that they've got going around in 2020 and 2021, that we're seeing that kind of not necessarily be the case from a disposable income point of view. And so
the other side of, sorry, Brad, to cut you off, but the other side of that coin as well is the leverage situation. I know that a lot of people in America who are leveraged up on platforms like Robinhood have had to sell their crypto positions to cover those margin calls, and that's going to be a triggering point to make it to make all asset classes draw down.
Yeah, I mean, on-chain analytics, usually around a 2 in this on-chain analytics around leverage is where you're just totally over-leveraged. It's insanity and the rest of it. Even after the crash from 60 down to 40, we're still sitting at 1.9.
Wow.
And so what we've just naturally seen over the last 4 weeks is a lot of long leverage be taken out over and over and over again, like 200 billion. Like some days it's like, $2 to $6 billion worth of just leverage being taken out. And so I think that's just like, something that happens to then create a new floor, and inadvertently we'll see where it goes from there. I mean, we have bounced up from the low 30s. I think we're sitting at 38,500 USD, not AUD, USD today.
Still in USD, mate.
I can't get off it. I'm sorry.
Can't get off it.
You got to say it in USD anyway. It just makes more sense. And Ethereum, I think Ethereum's around 2.6 and a half.
2.75 now.
Oh, 2.75.
Yeah,
it's pumped up.
We're up. It's pumped up. So I think what we're going to see, I mean, look,
where's
I think it's
SHIB?
going to be a rocky.
SHIB.
As long as the equity markets, and we'll see what happens with the Reserve Bank in the US in March and what that does, because it's all being factored in. But I think people have got to try and work out over the next kind of, I'd say at least another 2 to 3 months of volatility. We may see it drop down to the $20,000 mark, Bitcoin, or we may see it reconsolidate and in the 40s.
Well, that's a really good update, and what we want to come back to on the Q&A is where you're thinking from a crypto side of things for the year of 2022, Brad. So don't give that away just yet. I
just looked at the price of SHIB, boys, and it's US 0.0002169, 0.0002169. So it is lower than where I bought it. At one point, I had a 200% gain, and now I'm officially in unrealized SHIB losses. But the Sultan of SHIB will never sell. I will hold.
Not in a leverage position on it, mate. Not forced to sell.
Maybe I'll buy up some more at this discounted price. I still believe in the use case for SHIB.
Dollar cost in, mate. Get your new floor.
Dollar cost in. That's what I've been telling people.
I don't dollar cost, boys. I keep cash, and then I just YOLO.
Ape in, huh?
So we'll swing back to Brad in a couple of minutes with his thoughts for crypto for 22 and what he's thinking, what he likes. General in nature, as always, guys.
As always.
As always. And from a property perspective, Australia-based, I guess, we've seen a crazy 2021 where I believe all of the states and territories had an increase. Maybe only one was a negative, but I'm pretty sure all was a positive increase, which is one of the first times it's ever happened in Australia. Usually states and territories are like a diversified market. They all oscillate at different times from a property perspective. So, interesting. As I referred to earlier, the banks have come out with some forecasting, I think, for 22, 23. They're sort of thinking might potentially go negative. But as I also tempered that with, is the banks are generally always wrong when it comes to property predictions. Pre-pandemic, I think they came out, as I've said in a podcast before, if you haven't listened, I think it was one of the big majors, was a negative 35 to a negative 20 to a negative 10 to a positive 10 to a positive 20, all in the space of about 4 or 5 months. So they like to throw out predictions for the sake of throwing out predictions. So, but yeah, from my digestion of general overview of property side of things, I think this year should be another okay year, depending on which state and territory you're in. Depending as well a little bit on what the RBA decides to do, and if APRA comes in with any kind of further tightening of regulation in terms of borrowing. There's a few kind of standout states that I can chat to at the end here when we do the Q&A bit. Be mindful whenever you're looking at property, take what the banks say with a grain of salt in terms of bank forecasting. And just sort of have an overview of every state and territory is different in Australia. We've had a good year overall, but there'll be some, probably more subdued levels, but also some standout states, I think, as well. So we'll chat to that in a short moment.
Yeah. Any other thing I'll probably say is at the moment, Joel, what are your thoughts, Joel? Love to hear with some possible headwinds, possible. We don't know what the rate rises are going to do. We don't know if property is going to just go steady or it's going to go slightly up this year. But over let's just say the next 3 or 4 years, chances are there is going to be some rate rise. The rest of it, obviously, as a part of any sort of financial plan or financial big decision like property, a lot of people, I shouldn't just say Australians, a lot of people generally try to maximise, right, the amount they can borrow and right up to the kind of LVRs, and especially if you're a first home buyer, I think in Victoria, I think you can, this is like a 95% now, I think you can get in. What are your thoughts around that? Would you be telling, what's your opinion, not advice, opinion around kind of, is it the right time to be looking at taking some equity out and maximising that? Is it the right time to be like stretching yourself as far as, or would you be saying kind of take a bit of an easy go approach to those sort of things? I know there's a couple of people out there looking at properties, both from an investment perspective and also their first home.
Yep. Yeah, it probably depends on time frame, location, job security, serviceability. There's a range of different factors that come in when you're looking at it.
Best thing is to seek some advice, probably.
Yeah, seek personal advice around your situation, but time frame really helps cure everything. So if you've got time frame up your sleeve and you're able to stay in market and not be stretched, and have serviceability keeps you in a market. The old saying is serviceability keeps you in a market, capital growth gets you out. So it's no use having just one, not the other. But you want to sort of have that time frame to allow things to unfold the way you're wanting your portfolio.
I think that's unfold. The key, right? Honestly, I think that's the key.
Yep, over time, because in a few years we could see a slight negative, and if you're forced to push out, then you might come unstuck. But if you've got time frame, you've got an equity buffer, you've got an offset account, you've got some capacity in there, you've got some cash in there to withstand any kind of employment hiccups or job security hiccups,
rate rises.
Yep. Yeah, so they're probably some of the key things there.
It sounds like a cop-out, but really time horizon is always the factor, isn't it? But anyway.
The biggest.
The one thing
more and more in life.
The one thing I wanted to just touch on a little bit extra in equities before we go to our outlook and the Q&A is, since November last year, and Brad was sort of alluding to this earlier on, I think you were alluding to this, Brad, how we've had a huge sell-off in tech names. So it's almost like, even though indices are not that far from all-time highs, or they've come down only tiny bits.
Yeah,
NASDAQ and S&P are sort of not that far off. There's been massive drawdowns in some names. I got a few that I can rattle off here. There's Net, Datadog, Tesla itself has had a pretty big sell-off. Yeah, Unity, Splunk, Roblox, Coin. Wynn Casino, and I know we did an episode where you've recorded with Wynn in the background there. They've come down a bit. And Etsy, Oracle. So a lot of these sort of SaaS names and tech names have come down from November. And in hindsight, it's sort of easy to look at it and go, oh, I should have been short that, or I should have, using derivatives to buy some puts or something on it. But one name that I've been looking at is Twitter in particular. And they've come down heaps since their all-time high. And I feel like with a lot of these names and something like a Twitter, I feel like that's not justified. Like, it depends on what their growth is going to be. And I think they're reporting their earnings either this week or next week, maybe the week after. I might be getting lost here. But I feel like that there's just opportunities are presenting themselves in some of these.
Both ways, right? Back then it was opportunities downwards, and I think there's opportunities on the upwards.
But it's going to hinge on whether or not the Federal Reserve raises rates. And I feel like over the next 12 to 18 months, how fast and how much. And over the next 12 to 18 months, we're sort of going to get these buying opportunities coming up again and again in America, because as they say they're going to increase rates and then they do it. And I think we're definitely going to get 3 or 4 in before anything changes, unless there's some other event that, can always change it.
Another black swan.
Then you're going to see these names sort of hover around where they are or come down again into like really attractive valuation regions. And it's just something for the tankers to keep an eye on. It's just general in nature. Do your own research, but that's where I'm looking in some of those names.
Arnie's thoughts for 2022, and I reckon,
they're already coming in.
We should throw in a drinking game. Tesla. Anytime Arnie mentions Tesla, drinking game.
I'm sober though. I'll have to have a shot of tea or something. But and Bitcoin. Just touching on Bitcoin with the tie into an equity is formerly Square, now called Block, heavily tied to Bitcoin, and their price has sort of come down in conjunction with Bitcoin's price coming down. But I know that Jack Dorsey, who's the CEO of that company, announced they're going to be building an open Bitcoin mining platform, Brad, which I think is awesome, because I feel like even though they're both suffering, drawdowns at the moment, I feel like that's going to bring a lot of transparency to that space, and that's going to be ultimately a very good positive catalyst for both of those assets.
Well, just remember that any CEO's time horizon is 5-10 years, right? Yeah. So he's not looking at what the prices are going to be doing in the next 6-12 months. It's where they think the actual market's been, whether or not you believe in him and his viewpoint or other people's. They don't really look in that short-term space of what it's doing. It's more like, what are we actually setting up to be? So it's an important bit. Before we go on to what the next year looks like, just one other thing to throw into the tank. Just a quick update on China. Because again, America, we worry about what America does, but we've got to remember our biggest trading partner. I don't know if they're still a trading partner, but my guess is they probably still are, even though they've said a lot of no's to our products. There's a continued crackdown over there in tech stocks massively. So, you're seeing tech stocks over there, like your Tencent and that, down 70%. The property market continues to go down. So you're seeing a reduction, last month figures, 25% reduction, so a negative 25% reduction in overall new home sales and new constructions, which is huge. GDP growth estimated, and this is not just due to construction, this is due to a crackdown in both the entertainment industry, leverage, private schooling, which is huge over there, tech stocks, but also property. Revised growth down from 6% to 0.8%.
Wow, that's huge.
And so prices over there, the largest developer, so not the largest developer by debt in the property market, which is Evergrande, the largest developer also is now nearing their 3 red line policy, just due to the impact that Evergrande and a lot of the other, there's 160 other ones that have gone under, and some of them are bigger, like Kaiser and stuff like that, impact that their fire sales have been having on the actual valuations of property has now started pushing the assets of the top kind of developer near that red line. So it's just one to watch, because I think the remit there is that they wanted to kind of reel in a number of parts of the economy, and they've done that during when China had its strongest quarters last year and got kind of like 6% growth again. And they thought there was enough growth in there for it to weather the storm of some other things. Just an interesting one just to keep watching, because, for instance, iron ore went down from $230 a ton down to 83, and it's back up to 130. but you have seen a 50% drop in that within about an 8 or 9 month period, and that's our biggest export here in Australia. So just remember that from a revenue perspective of taxes and royalties. So
yeah, I think I remember the budget, the Fed budget they did mid last year. They very, very conservative on their iron ore price, which is
have to be otherwise.
Hindsight, very, very smart. So
very smart, right?
Yeah, so they're quite.
Because worst case, it stays up at 230, and you have a massive budget surplus.
Yeah.
Downside, it obviously has that. So that's just and obviously gold isn't doing much at the moment. But I'll touch on the other ones, like lithium, that in my overall.
Cool. All right. So if we want to do maybe a minute in each area, so a minute talking maybe some stocks with Arnold, I can chat a minute on property, and Tabone a minute on your thoughts for crypto for this year.
Oh, just anything you want to add as well. But
I might add a couple of PSs in the equities.
Yeah. Add anything you want.
But property, I don't know that much, so I'll just sharpen that one.
Yeah, I know nothing about property, so that's all you, Jolly. You can kick it off if you want.
We can all add some PSs onto all of our sections as we do.
So this is so we're going to address the Q&A question.
Yeah. Where did it come from this week, Arnie?
So Carl with a K, our long-time listener, probably our most valued listener, Carl with a K, wants to know what we're going to do with our own personal investment strategies for 2022. So we can't tell you exactly what to do, Carl. So it's general in nature, do your own research, but we can talk through what we think will happen over the course of the year, and maybe just give you a bit of an insight into what all three of us are thinking. And I guess,
Yep, sure.
And that can feed into the 50-50 as well.
Arnie, who's kicking off first?
Well, I'll kick off first. So I think
Tesla.
Well, Tesla would. You know what? I actually did the numbers on Tesla last week just to check the valuation and just check my own valuation, I should say, because valuation is a subjective thing.
Yeah, let's say.
and the inputs can be tweaked and manipulated. But for me, the current price of Tesla, I would not be buying it, and I'm not going to buy it. But I think my fair value at a 50% compound annual growth rate, which, will they be able to keep growing 50% year on year and year on year? I don't know, but they reckon they're going to do it for this year. And the fair value set around $943 based on a 50% growth rate. So, and that was, based on a whole bunch of other assumptions. So would I buy it at the fair value? No, I always look for a margin of safety, which is one of the key value investing principles. So they say 50% to be safe. So for me to be buying Tesla, it would have to come down to around $450, $500 mark. But yeah, I'm not.
My fair value is about $750 on Tesla, FYI.
So you got $750? I will.
Yeah, so $450, $500 is probably around where I'll come in, honey.
We're pretty close, mate. Yeah, I think I wouldn't mind comparing valuations if you want one day. But anyway, so that's what I'm thinking on that one. But yeah, in general, I think stocks this year, particularly in America, which is where I predominantly look. I look everywhere. Like I own a few dotted around the world, but America is where I like to look the most because it's just a great market to look in. And I think the ones that I have been looking at are Twitter. And what I've actually been doing with Twitter is I've been selling cash secured puts on it just to get some premium rolling in whilst I try and wait for the price to come down to my target. And unfortunately, it hasn't come down low enough. I've been close a couple of times at expiry, but it never gets there, so I haven't been assigned. But it's okay because it's just money rolling in the door and I don't have to do anything. It's something I want to buy anyway. But in general, what do I see the outlook for 2022? I think in America, it's going to all be based on the bond yields and the rate rises. And I feel like there's potential for, if something happens in the economy and the Fed is just inflexible and doesn't react to it, I could see a recession or a crash happening in America in the second half of this year. And for that reason, I'm being very cautious with what I do, and I'm just keeping cash on the sideline. And I am putting where I think something is attractive, like on Twitter. I would say if Twitter ever got down to something like $25, that's like I'd be smashing the buy button. But it's nowhere near that at the moment. I think it's like 36 or 37. So most of my strategy is just slowly take cash off the table in names that I own that have appreciated a lot, and then look for these opportunities to buy, because I do think there's some more short-term pain coming. And that for me is the best buying opportunity, because I like to look at stocks with a long-term view. And when I buy, I'll be holding for a while. But it's these short-term buying opportunities, like with the Fed rate rises, that will cause these drawdowns in the broader market. And as I was sort of alluding to before, without the big cap names like, FANG, Facebook, Apple, Amazon, Netflix, and Google, and Tesla. Well, Netflix has had a massive crash now, but it's come down. I think it's come down a lot, but like more than half, right? Over 50%. This is Netflix, I mean.
Yeah.
But basically, before that happened, those stocks were sort of keeping the indices propped up, and Apple's still doing it. Like Apple at the moment reported their earnings, and if you just looked at the indexes, you'd think they're doing pretty well. But basically, it's because Apple is just dragging it up and up and up. And Microsoft, another one. So
Microsoft's earnings smashed it out of the park.
But I sort of wonder about, I think a lot of these companies that have had access to cheap liquidity and it's going to be drying up and they've got debt and they can't service it because they're not making any money, there's going to be a lot of pain there. And I think we're going to see, as a result of that, you're going to see some names who are probably undeserving of massive drawdowns, get massive drawdowns, and then there'll be buying opportunities there. So tech and growth, I feel like tech and growth won't rebound super strong this year in the face of rate rises and quantitative tightening, which the Fed's going to be letting the assets sort of reach maturity and the balance sheet shrink a bit. But I feel like that's going to be the best time for you to buy if you've got that long view. And also, if you're playing the short term, then you could play it to the downside. Because I feel like every time one of those rate rises happens, and I think the first one's been signaled for March, there's going to be a dip. And it's, is a dip going to rip, or should you buy up the dip? So that's sort of where I see it, boys. Did I miss anything? If you want any quick questions for me, hit me up. Q&A if you want to fire it off at me. Carl, I hope that answers your question.
Good question.
Good answer. Jump in next. I'm going to start pretty much in line with you. I mean, to be honest, I probably see it's been quite volatile. 2022, I believe, is going to be areas of pockets of continued growth. I think EV space is probably going to continue growth, but again, so Tesla fair value much less than where it is. I think inputs into those areas, lithium, cobalt, all the rest of it are going to continue just seeing growth for the next 5-10 years, and that's just more of a macroeconomic worldview in terms of change of industry. So I think there's still some pretty safe resource stocks to kind of look into. I wouldn't really necessarily be playing at the moment in the small miners, your little cent miners, micro caps, but your solid kind of resource companies with solid proven jorks and resources in that space, I think is a safe play. Being a person that has a large part of my portfolio in a tech stock, being my private company, I think tech stocks is like what Arnie said. I think they're probably going to get smashed this year. Is my personal opinion. Do your own research. Blah blah blah. I think there will be some continued strong ones, but I think overall, as much as people kind of try and put the rate rises and bank everything in and the free money in and the rest of it, I think there's just too many variables at the moment. And whenever the market is a little bit jittery and kind of volatile, and the VIX has been up and the rest of it come back down a little bit, but which is the volatility index, I think all it takes is you get some good news and it stabilizes. It doesn't necessarily go up, and you get any sort of bad news and it just will drop again, right? And that's just a mentality out there at the moment. So I think there's more chance of downside than there is upside in the equity markets in this year. And so I think what Arnie said is quite prudent and smart around, your view or your time horizon is a huge thing. I think, for me personally, my timeline horizons on stocks, on crypto, on property is all 10 years plus. Right, so 5-10 years plus, and so looking out for those fair values where the market has oversold, and there's going to be those buying opportunities this year, definitely. If I had money on the sidelines at the moment and looking to jump in, I'll be waiting for those, and I'll probably wait and see. I've been saying this to a lot of people. My opinion is this quarter is a pretty pivotal quarter in terms of it's going to have its first rate rise. We're going to find out CPI numbers in Australia. We're going to find out further CPI numbers around the world. We're going to see what impact that has on tech stocks and the rest of it. So I'm more of a wait and see kind of person at the moment. I've got a lot of my portfolio that hasn't been kind of attributed to an area, just sitting in cash, and I'm waiting another 3 months. I'm not pushing the button really on anything, even on crypto, even where crypto is at the moment. I think. Yeah,
I was going to say that was a question. Is it sort of wait and hold on?
I'm waiting and holding on
crypto as well.
Crypto. Yep. I think the crypto is so volatile naturally.
Yep.
And because it is tied to the broader markets and institutions now, I just think again whether I agree on it or not in terms of it going down, I just think that there is a big chance of it getting hit again, especially over the next 3 months. Is kind of where I'm seeing things. So I'm in a bit of a holding pattern on a whole bunch of my portfolio at the moment. I've got a bit of property, a bit of just out there, a bit of property, a bit of precious metals in hard precious metals. I've got my crypto, I've got some resource stocks, and a little bit of tech stocks. And that's basically where I'm sitting at the moment. And just kind of seeing where the next 3-4 months kind of takes us.
Precious metals have been a good. I mean, they've dropped a little bit, but year to date, I think it's like 2%. So if you're talking
about 2-3% movements
in terms of like a security asset or a flight to safety asset, it's done its job. Like if you put your money in metals in the last year because you were thinking that when there's a big sell-off, you could now sell your gold and buy up, things at discount. So, but you're happy to have
more of just purely that, Arnie. Like, people say that, if there's a massive crash, gold will fly and all the rest of it. Maybe it will, maybe it won't. But will it probably hold its value? Yes. And will that allow me to provide some liquidity to then, maybe a slight inflationary hedge and the ability to get some liquidity into something either this year or next year? Right?
I own gold miners for that reason. I don't own any physical gold, but I do the same thing as you. I have like a
miners are a good way, right? I own some miners as well, like Newcrest and the rest of it. So that's.
As long as they're not your 10-cent miners, where
we're
talking
the penny gamblers,
quality miners, where they've actually found a precious metal.
They're actually mining a precious metal. Even if you find it, you still get that thing of mobilisation of mining, which is
Thanks for the recap, gents. From a property standpoint, keep an eye on a few things. Keep an eye on rental squeeze. We're starting to see a little bit of rental squeeze come in from policy from government a few years ago in terms of the changing of APRA standards with lending to investors, and government to an extent as well, with almost disincentivising investors with property ownership, with tenants and landlords, and the kind of sway of the pendulum there. So keep an eye out. They're starting to get some really tight rental squeeze in certain areas and significant rent rises we've seen the last year as well. So, lack of supply has caused a real push in rental surge around.
Is that mainly housing, Joel, rather than apartments?
Yeah, correct.
So I haven't really seen it on my apartments.
Depending on what sort of property you're in and what area you're in as well. So certain areas where people are going to for work, they might not be wanting to buy in that area. They're really struggling to find a rental. Vacancy rates are super low. And the increasing cost for rental accommodation has had some significant increases. So keep an eye on that. Apartments, you sort of just probably touched on. The next point is maybe areas to steer a bit clear of is apartment side of things. There's a significant oversupply in certain areas. We've seen Sydney, Melbourne, Brisbane as an example, haven't done a heap. They'll probably have some rental slack taken up because there's probably higher vacancy rates, I believe, at the moment in, as an example, the Melbourne apartment market. So as migration kicks in and students come back in, we'll start to see that kind of slack taken up a touch. But as an investment side of things, probably be steering a little bit clear still for a while to come, just because there's so much supply available and you don't
and continued supply. I can say to people, being kind of structured market focus with my business. There's a lot more come on the market, and even build to rents are starting to become a big thing as well. So
So when you talk about supply demand economics, you've got more and more supply. If a 50-story apartment building can come up right next to another 50-story, then you're sort of doubling that supply straight away. So when I talk apartments, I'm more talking kind of high rises and small apartments. And separate to townhouses and units, I believe. I guess in terms of suburbs and where we're going to see in states as well, a couple of areas to keep an eye on that have done quite well, but I think there's still more to run in is Queensland and Tassie. So keep an eye on that. Keep an eye on the regions and sort of your suburbia type thing as well. So your regional area, I think there might be still a bit to run in. Queensland's had some good internal migration come up. We're going to see some pressing factors of migration come back into the country too. Are we going to be attractive to overseas travellers, one to either come and holiday or one to come and stay? That'll be an interesting thing as well. So that's why I think there's still some to run in property, and depending on which state, it will depend on the outcome. But there's a couple to look at. So there's my two, Bob.
And you got a little bit of what you're doing, Jolie?
Yeah. So what do we got? Sort of some stocks, a couple of stocks, just diversified stocks, some property, and they're the main things. I mean, a little bit in crypto, nothing huge, but yeah, they're the main things for myself. Superannuation. Long-term, superannuation is always super aggressive and internally geared fund because we've got such a long time frame until we've got accessibility to it. So
yeah, mine's aggressive. I never touch it. Just leave it on aggressive.
Yep. Same, just leave the button on hold, right?
Yep. So that's seek personal advice, always general in nature whenever we're discussing these.
Depends on your age and your risk profile and all that.
Absolutely.
So
seek
Joel, if you had some money on the side right now, what would you be doing?
Wait, Jolly, hang on a minute. Sorry, Brad, hold on a moment, because that is today's 50-50, or should I call it 33.33, 33.33 and 33.33? Yeah, because I want to know, and this is Carl with the K's 50-50, if you had money on the side and you were forced to choose between crypto, real estate, or equities, you have to choose. You have to choose one, boys. All right. This is and then we can get some general thoughts about. We'll relax the rules a bit. But if you were forced to choose one, and you had the same amount of money, and it was or everything's kosher, what would you choose this year?
So obviously, we've got enough money to buy property here. So
yeah, you got enough money to buy property. It's enough to buy
$1 million worth of free cash.
All right. Let's say 1 million. Yeah.
All right.
Joel, you go first. What would you choose?
And can you only pick one asset class?
You can only pick one for this, but then we'll elaborate a little bit.
Spread it all, mate.
You can't.
That's not the answer, Joel.
So stocks, crypto, property,
and precious metals. We'll throw in there, right?
I say precious metals. Make it a quarter.
I don't know. I reckon let's have a play the roulette wheel and just throw it into crypto and see how we go.
I love it. Joel's got a million on the side and just dumps it into crypto.
Throw it into SHIB.
SHIB, yeah. Oh, great. All right. I like it. Braddles, what would you pick?
Look, for me, I would actually be putting it into precious metals. That's where I'll be at the moment, only because it allows me to wait and see without much downside risk, right? If I was looking for growth at the moment, I probably would start DCAing it into crypto. And basically only into your layer one, so your top, let's just say top 20.
Top tier, top tier. So SHIB then.
I'll DCA it over the next. SHIB's in there. Okay, top 20 minus any dog-related coins, or any stable coins. I'll probably, if I was looking for growth, I'd definitely be just DCAing it over the next 3 months to kind of reduce that volatility either up or down a bit. If I couldn't and I only had one place, I'd be buying up some silver and gold.
I like a lot of the dollar cost throw in there, mate. It's great. And I do like your idea of precious metals too. So I might actually steal your answer and say, I thought for a bit of fun, mate.
Just shit.
Throw it in.
For a bit of fun.
Might become a billionaire. You never know.
All I want to say in response to you removing the dog tokens from your analysis is have fun staying poor, mate. Have fun staying poor because SHIB's gonna go to the moon. Anyway, what would I choose?
Do your own research and your own decisions.
Yeah, this general in nature. I say SHIB's going to the moon, but I say that with a genuine lack of understanding about SHIB itself and the crypto markets. I'm a straight up noob.
And it's tokenomics.
Yeah, exactly. But Shibarium. Anyway, what would I do? I would invest the full $1 million into equities. And yeah, no.
What equities, Sonny?
Well, I was going to say no prizes for guessing which one I think is attractive at the moment. It's Twitter. So if I had to spend it all this year at its current price level, I'm pretty comfortable with Twitter. If I'm allowed to tweak this a little bit, because you boys have tweaked it a little bit, I would still be selling cash secured puts and try and get a better entry price.
Yeah.
But yeah, no, I'd be all in on that. I think
so
that's
if we
awesome.
Just set up a shareholder agreement, we'd be pretty well diversified, guys.
If we have a combined portfolio, money.
One question on you, Sophie. Are you a fan or not?
I don't know.
A banking license.
Yeah, I don't know a lot about it. I saw that pop out because blokes I know who are very interested in that space, when it got the banking license, it shot up, and I had a cursory look at it. In general, it doesn't really fit my investment philosophy, because I like to invest in things that are proven. So I want something that's got 10 years of financials and, is making money, and I've got a margin of safety, and I like the management and I understand it. So, for example, I am invested in Square because I feel like Square does a similar thing to SoFi.
Yep.
With
more proven, right? So.
I think so. But would I buy Block? It's called Block now. Would I buy Block at the current price? Probably not. I feel like I bought it.
Facebook and Alphabet now.
Yeah, they keep changing their names on me. But yeah, I bought Block when it was Square and it was a lot cheaper, and I wouldn't buy it right now. I don't think at its current valuation. But
well, gents, we're getting close to end of time today. I know Arnie's pressing. I've got a pressing appointment, so it's been terrific to catch up with everyone and shoot the breeze on what our thoughts are for 2020 macro predictions and thoughts. So
2022, Jolly, 2022.
2022, you're 2 years behind. But what we will do is at the end of this year, come back and actually play this and see where we actually were.
Yeah, okay. Let's do it. I love it, absolutely.
Be real.
So, we might have to just for S and Gs without swearing. We might put some guesses at next podcast on the indexes. What we think. The Dow, the All Ords.
And we'll throw in Bitcoin price there and ETH price.
Yeah,
let's do that.
USD or AUD, we'll have to.
And then property up overall in Australia. We'll do that.
Okay, start the next pod. We'll make our official guesses.
Yes, I love that. All right.
The next couple of weeks are going to be crunching numbers.
Yeah, so we can't rest a month for our next pod. So we'll be back soon, guys. It's been a pleasure to catch up with everyone as always. And socials, Arnie, how can people get in touch with us? We want to keep those questions rolling in. We love them.
At Money in the Tank on Facebook, Instagram, Twitter, and YouTube. And please subscribe to the YouTube and comment because it helps the algorithm and helps us out. So cheers.
Love it. Hopefully we'll fix camera by next time so I don't keep clicking on it.
All good, mate. No
See
worries.
you, boys.
Thanks, guys. See ya. Bye.